Now we've covered the basics of cryptocurrency put options, it's time for some more live examples. These next two examples will be on Deribit and will be very similar to the examples in section 4, except this time, of course, we will be trading cryptocurrency put options instead. In this first example, we are going to buy a Bitcoin put option live on the Deribit website. We will walk through the process of navigating the Deribit option chain, locating the option, using the order form, and placing the trade. We will then look at our potential profit at expiration, taking into account the premium we pay and the strike price, and we will then let the option expire. Once the option has expired, we will analyze how the position performed and calculate how much profit was actually made. Let's first take a quick look at the current price of Bitcoin. This is a chart of the Bitcoin price on Coinbase. This is a 4-hour chart, so each candle represents 4 hours. Today is Thursday the 21st of January 2021, and Bitcoin is trading at about $31,684 on Coinbase. The price of Bitcoin has been decreasing all day so far. Let's say we're not sure if the price is going to rebound, as has happened a couple of times recently, or if this decrease in price is going to continue. But either way, we would like to partially hedge our account's USD value against further downside, while still maintaining our long spot position if price does indeed rebound higher. To achieve this, we're going to buy a Bitcoin put option with a strike price of $30,000 that expires in 2 days on Saturday the 23rd of January. Let's head back over to the Deribit option chain. As a brief recap, we have the strike prices in the middle column, with calls to the left and puts to the right. The equity in this account is currently 0.2 Bitcoin, and we have no other positions, so we will use a quantity of 0.2. This way, if the Bitcoin price continues strongly to the downside, we will be protecting the USD value of our account for any moves significantly below 30,000. As you can see in the top left, I have the 23rd of January option chain expanded, so every option we can currently see expires on Saturday at 0800 UTC. We want the $30,000 strike, which we can find in the middle column, and we want the put, so we move right from here. The current best bid is shown in the bid column in green, and the current best ask is shown in the ask column in red. These prices are an amount of Bitcoin. For example, a price of 0.015 means 0.015 Bitcoin, or 1.5% of a Bitcoin per contract. We can click the $30,000 put in the option chain, which brings up the order form for this option. This includes the order book of bids and asks on the right, which is the list of other traders' orders that we can execute against if we choose to. As we want to buy this $30,000 put option, it is the current asks that we are interested in. The current best ask for this option is fluctuating between 0.015 and 0.0155 Bitcoin. So let's use 0.015 and we should get a fill. As we mentioned, our desired size is 0.2, so we will also enter an amount of 0.2. Once we've entered this amount and check the price is correct, we can click the buy button. This will bring up the order confirmation screen where we can double check everything has been entered correctly. Everything is correct here, so I will click the buy button again to create the buy order. This order has been executed immediately. The pop-up in the top right of the screen lets us know that the order was filled. We can see our position in the position column in the option chain, and we can also scroll down to the positions table to see our long put sitting in the account. Time to take a look at what could happen at expiry. Let's remind ourselves of the option parameters we have for this position. The underlying asset is Bitcoin, the option type is put, the expiry date is the 23rd of January 2021, the strike price is 30,000, the option price or premium is 0.015 Bitcoin per contract. The fee was also 0.0003 Bitcoin, so we will use 0.0153 Bitcoin as the total cost. Given all the parameters we just covered, this is the P&L chart at expiry for this option. For any price of Bitcoin above our strike price of $30,000, we will make the maximum possible loss. This maximum loss is limited to the premium we paid plus the fees. We paid a premium of 0.015 Bitcoin per contract, and the fees were 0.0003 Bitcoin per contract, This gives us a total cost per contract of 0.0153 Bitcoin. As the contract multiplier is 1 and we purchased 0.2 contracts, this equates to a total maximum loss of 0.00306 Bitcoin. If Bitcoin is any price below our strike price of $30,000 at expiry, we can calculate our profit or loss using the formula from lecture 6.2. This was strike price minus Bitcoin price divided by the Bitcoin price minus the premium, all multiplied by the position size. Except instead of using just the premium paid per contract, we can use our total cost per contract, including the fee. We've also added on the position size multiplier, which is just the number of contracts, in this case 0.2. The profit or loss line increasing to the left of our strike price is just this same formula plotted for each underlying price of Bitcoin at expiry. As an example, if the price of Bitcoin continues moving down, moving all the way to $26,000 at expiry, we can calculate our profit as 30,000 minus 26,000 divided by 26,000 minus 0.0153, all multiplied by 0.2, which equals 0.0270 Bitcoin rounded to 4 decimal places. This would leave us with an account equity of about 0.227 Bitcoin, which with a Bitcoin price of $26,000 means the USD value of the account is about $5,902. Without this put option, the account would still have just 0.2 Bitcoin in it, which would have a value of only $5,200. So while this account hasn't retained quite as much of its USD value as it would have done with a simple 1x futures short as a hedge, due to the premium paid for the option and the put being out of the money, the put option has helped the account retain more of its USD value than would otherwise have been the case with no hedge at all. It has also done so while enabling the account to participate in any further upside, which the futures short would not have done. Don't worry if you're not quite following this talk of hedging. This example is really just a gentle hint at the subject, which we will go into in much more detail later in the course. In lecture 6.3, we gave the formula for the break-even point of a cryptocurrency put option as the strike price divided by 1 plus the premium. As with the profit calculations, instead of using just the premium paid, we will use the total cost including fees, which is 0.0153 Bitcoin per contract. The break-even point is then calculated as 30,000 divided by 1 plus 0.0153, which gives us a break-even point of $29,547.92. This is the point at which the profit or loss line crosses the x-axis. Now we've had a quick look at what could happen, let's jump forward and find out what actually did happen. Here we have the same 4-hour price chart of Bitcoin we looked at just before placing the trade, except now of course it's 2 days later on Saturday the 23rd of January 2021, and our option has expired. We can see the point in time we bought the call option here on the 21st. Initially, price did continue to the downside, past our strike price of $30,000. However, it then rallied higher for the next day, eventually delivering at a price of $32,889.75, well above our strike price of $30,000. This means the option has zero value at expiry, resulting in the maximum possible Bitcoin loss for this trade of 0.00306 Bitcoin. Remember that earlier we described our motivation for buying this put as wishing to gain some protection against a further decrease in the price of Bitcoin, while still getting to participate in any increase in price. So, how have we performed in that regard? Well, when we bought the put option, we had 0.2 Bitcoin in the account, and the Bitcoin price was roughly $31,700. This meant our account was worth about $6,340. We spent 0.00306 Bitcoin on the put option, which was worthless when it expired, leaving us with 0.19694 Bitcoin in the account, a small loss in Bitcoin terms. With a Bitcoin price of $32,889.75, using the delivery price when the option expired, this left our account worth $6,477.31, which is $137.31 more than we would have had if we had simply sold all the BTC instead of hedging the downside with a put option. So we had some downside protection from the put, but did still gain in dollar terms from the Bitcoin price increasing. Again, this is very much just scratching the surface of hedging and is just meant to spark a few thoughts on what is possible with options for now. If we go to the menu and click Transaction Log, we have access to every transaction in the account. We can see the transaction where we initially bought the option here. The option details can be seen in the instrument column. It was a buy order to open the position. The amount was 0.2, and we can see the total change to our account in the change column, which was 0.00306 Bitcoin, including the fee. In the row above, we have the expiry of the option. If the option had some value, this is where we would receive the value of the option back into our balance. As the option had no value at expiry though, nothing was received. That's it for this first cryptocurrency put option example, but don't worry, there are plenty more to come. In the next lecture, we will work through another cryptocurrency put example, but this time we will be the seller of the put instead.